Hello everyone, Professor Hallows here again. I'm going to be talking to you about Chapter 6, which is bonds and bond valuation. This chapter really introduces you to an important part of the capital structure for most firms, and that is bonds, or debt. It talks about the size and the depth of the bond market and the types of bonds that are traded in this market. You know, most bonds are either zero coupon or coupon bonds, so we will be talking about that in this class, and the characteristics of both bonds are compared. We're going to use the bond's yield to maturity, which is the rate that equates the present value of the bond with the current market price. We're going to look at the impact of interest rate on bond prices. When interest rates change, what happens to the bond price? We're going to look at, and the cash flows from those bonds are explained using both zero coupon bonds and coupon bonds. You know, financial professionals, bond traders, tend to quote bonds in terms of yields. And this concept is really an important one. How bonds are affected by interest rates is easily understood, most easily understood, by looking first at risk-free securities and their yield curves. And then we extend this concept to bonds that have risk of default, because some companies will not be able to pay back the principal or the bond to the investor, and this is risky for the investor. When first issued, bonds are likely to sell very close to their par value, which is normally $1,000. And I'm going to repeat this several times in these intro videos, in class, in the materials that you have on My Finance Lab, etc. Then we're going to conclude this chapter with an analysis of how the risk of default creates credit spread among various rated bonds, and we'll look at corporate bonds for this chapter. We're going to talk just use the terminology of bonds so you get familiar with how bonds, the price, the yield to maturity, different terminology that's used in the bond market. We'll look specifically then at zero coupon bonds. As that states, a zero coupon bond pays no coupons, and you buy it for a certain amount, and then at the end of the time to when it matures, they will pay you back the full value of that bond. We'll talk about those. Then there are coupon bonds, which do pay you a coupon payment, usually twice a year, but sometimes once a year, sometimes even 4 times a year, but normally twice, until your bond matures, and then you're paid back your initial principal. We see that bond prices change throughout the time that you may hold them, or after they're issued, until they mature. So what causes this to happen? We will be discussing that. And then we're going to focus at the end of the chapter on corporate bonds. As a result, there are 5 intro videos. This first one is an introduction, and we'll talk about the bond terminology. When you're done with this chapter, reading the chapter before you come to class, listening to these intro videos, going to class, doing your My Finance homework and quizzes, etc., you will be able to understand bond terminology. You're going to be able to compute the price and yield to maturity of a zero coupon bond and a coupon bond. You're going to analyze why bond prices change over time and understand why they do change over time and what that means for the investor. And you're going to know how credit risk affects the expected return from holding a corporate bond. If the company is riskier than average, that's going to affect the price of the bond and also the returns from holding that bond. The bottom line at the beginning of this chapter, however, remember that as with any asset, the value of a bond is simply the present value of its future expected cash flows. So, the value of any asset is the present value of the expected future cash flows. With a bond, a stock, a project, a whole company. So we're going to emphasize that throughout the course as well. So let's look at some bond terminology. First of all, a bond is a security sold by governments and businesses, corporations, to raise money from investors today in exchange for a promised future payment. And the future payment is either coupon payment and the return of the initial investment in the bond, or just, as in the case of a zero coupon bond, the return of the initial investment. Bonds are debt. The companies and the government are borrowing money from investors. So there is a par value. The principal or face value, also known as par value, of a bond is the notional amount we use to compute interest payments. Typically, the face value is repaid at maturity. Maturity could be 5 years, 10 years, 20 years, 30 years. Governments have basically long-term bonds are 20 or 30 years to maturity. And typically, the principal amount repaid is $1,000. Unless you're told otherwise, assume in any problems that we work in class that the par value is $1,000. The coupon interest rates are also called coupon payments. Bonds promise additional payments, sometimes called coupons. The bond certificate, or what the bond is issued, there's a bond certificate that explains all the features of the bond, typically specifies that the coupons will be paid periodically, either annually or semi-annually, until the maturity date of the bond. We're going to talk more specifically about how you compute this as we continue on in this chapter. So bonds have a face value, usually $1,000, and sometimes they pay coupon payments, coupon interest payments. The maturity is also called the maturity date of the bond. It's the time remaining until the repayment date is known. Is the term of the bond, but the maturity date is either 10 years from now, 20 years from now. It's when the bond matures. The issue date is when the bond is issued. And then the settlement date is the date that you settle on the bond, usually at maturity. Sometimes there are call provisions in a bond, and a company may want to buy back their existing bonds and reissue them. Well, what's the most rational reason for doing that? If you think about it, if you have 8% bonds outstanding, you're having to pay 8% a year on those bonds, on the outstanding maturity value. But if interest rates go down to 5%, you could save $30 a month, or save the difference between paying 8% and 5%. So sometimes there are call provisions in the bond. This makes the bond riskier for the investor, but it makes it less risky for the firm. So we will talk about call provisions and callable bonds as we proceed through this chapter. Bonds are also rated by bond rating agencies. The most famous is Moody's, Standard & Poor's, and Fitch. We'll talk about how those bond ratings affect how much a firm has to pay in the form of coupon interest payments. And then the bond certificate. The terms of the bond are described as part of the bond certificate, which indicates the amounts and dates of all payments to be made on the bond. So the terms, as well as all the amounts and dates of payments to be made. Generally, this is bond terminology. As we use this terminology more and more, you'll get more used to it, and it will become second nature to you. Look more specifically at the coupon payment. I did say that some bonds did provide coupon payments. Well, the amount of the coupon payment is determined by the coupon rate of the bond, and it's set in the bond certificate. The coupon rate is stated as an APR, an annual percentage rate. That's an annual rate. So the amount of each coupon payment, CPN, is computed as follows. It's the coupon rate times the face value of the bond. Remember, we said that most of the face values of the bond were $1,000, unless you're told otherwise, divided by the number of coupon payments per year. Usually that is 2 payments per year, so the bond is pays coupon semi-annually, but sometimes it can be 1 payment per year. So let's compute the coupon payment if the coupon rate is 6%. If you take a look at this equation, the coupon rate, substitute 6% there times 1,000. And what do you have? You should have $60. Divided by the number of coupon payments per year. Let's say that this bond makes payments annually, so one time a year. The denominator would be 1, so 60 divided by 1 equals 60. Now let's compute the coupon payment if coupon payments are paid twice a year. And it's still 6%. The coupon rate is 6%. Times the face value of 1,000, that's still 60. But now the denominator is 2 coupon payments per year. So your coupon paid is $30 every 6 months. Now what happens to the coupon paid as your interest rate goes up? If it goes up to 8%, 8% times 1,000 is 80 divided by 1 is $80 a year. Divided by 2 is $40 a year, but twice a year. So your payment is $80 a year. Let's say the coupon rate is 4%. Generally, coupon rates currently are fairly low, 3 or 4%. And of course, it depends on the riskiness of the company and some other things that we'll talk about later. But let's say we have 4% coupon rate times 1,000. That's $40 divided by 1. That's $40. If we divide it by 2 payments per year, $20 a coupon rate payment every 6 months. Multiply it by 2, that's $40 a year. So that is how coupon rates are computed. One last thing, the bond certificate is sometimes called the bond indenture. And it's the contract between the company and the bondholder that includes the terms of the bond, how many bonds are issued, if there's any collateral that's being used as property to secure the bonds, whether there are sinking fund provisions. This is when you set aside money yearly, usually, to on paper to ensure that you will be able to pay back the bonds when they are due and when they mature. It also lists any call provisions. A call provision is when you buy back your bond if interest rates fall, and if there's any protective covenants. We'll talk about protective covenants more in class, but the bond indenture gets its name from the indentured servants of the 16th, 1700s. An indentured servant was someone from the old world, from Europe usually, who was given passage their passage was paid to the New World, which was the colonies or the United States. Of course, it wasn't the United States back then. I know you learned this in 5th grade. So just think back on your indentured servant from 5th grade. The indentured servant then had to work off the debt from being paid his or her passage over to the New World for 7 years. That is where the bond indenture gets its name. And it gets its name because the indentured servant had certain responsibilities to the person who paid their way over, and the person who paid their way over had certain responsibilities. So just a little bit of history for you from where the word bond